Every crisis in modern history has destroyed millions of investors following conventional wisdom. But there's a pattern hidden in the wreckage. A four-asset combination that not only survived every major financial catastrophe of the last century, but actually thrived while everything else burned. The 1929 crash that wiped out 89% of the stock market. The stagflation nightmare of the 1970s that destroyed traditional portfolios. The 2008 meltdown that brought down entire banks. The COVID panic that sent markets into freefall. The 2022 bear market that crushed the classic 60-40 strategy. 5 different crises, 5 different causes, but one portfolio structure protected wealth through all of them, and the math is undeniable. Most investors get destroyed because they follow the same broken playbook. Buy stocks when times are good. Panic when times are bad. Diversify into bonds that fail when you need them most. Trust that this time will be different. It never is. The wealthy know something different. They understand that real protection comes from assets that move independently, assets that profit from chaos, assets that governments can't manipulate or print away. This isn't theory. This is documented performance across nearly a century of data. The 4-asset Shield portfolio allocates 42% to stocks, 38% to fixed income, and 20% to commodities. Simple numbers that hide sophisticated strategy. Because it's not just what you own, it's how these assets interact when everything goes wrong. When stocks crash, bonds rally. When inflation destroys bonds, commodities explode higher. When deflation crushes commodities, stocks become bargains. The rotation never stops, the protection never fails, and the results speak for themselves. Let me show you exactly what happened during each crisis, and why this combination worked when everything else failed. Because understanding the pattern isn't just about protecting wealth. It's about building wealth from the chaos that destroys everyone else. The next crisis is coming. The question isn't if, it's when, and whether you'll be positioned to profit or positioned to lose everything. October 24th, 1929, Black Thursday, the day that changed everything. The Dow Jones Industrial Average began a slide that would destroy 89% of its value over the next 3 years. Millionaires became penniless overnight. Entire fortunes built over decades vanished in weeks. The Roaring Twenties became the Great Depression, and almost everyone was caught completely off guard. But not everyone lost everything. While the stock market was collapsing, government bonds were quietly delivering positive returns. 15% positive returns, while stocks lost 74%. The difference between financial ruin and financial survival was diversification. The investors who survived understood something that most people missed. Economic crisis doesn't destroy all assets equally. It creates massive shifts in value from one asset class to another. Here's what actually happened during the crash. The total return of a balanced portfolio holding 60% stocks and 40% bonds was negative 50%. Brutal losses, but survivable. Compare that to investors who went all in on stocks. They lost 74%. The difference between losing half your money and losing 3/4 of everything. Between having capital to rebuild and starting over from nothing. The lesson wasn't just about bonds protecting against stock crashes. It was about understanding why diversification matters mathematically. When you lose 50% of your portfolio, you need 100% gains to break even. When you lose 74%, you need 285% gains, the difference between a difficult recovery and an impossible one. But the 1929 crash revealed something even more important. The danger of leverage and speculation. Buying stocks on margin with as little as 10% down was common before the crash. If your stock rose 10%, you doubled your money. But when stocks fell 10%, you lost everything. Leverage amplifies both gains and losses. In a crisis, it destroys you. The investors who survived had learned to think differently about risk. They understood that protecting capital was more important than maximizing returns, that surviving to fight another day was better than betting everything on continued good times. The crash proved them right in the most brutal way possible. The 1970s brought a different kind of destruction. Stagflation, high inflation combined with slow economic growth, a combination that traditional economic theory said was impossible. But there it was, destroying portfolios and confusing experts for an entire decade. The S&P 500 gained just 17% nominally during the entire 1970s. With inflation running rampant, that translated to a 50% loss in real purchasing power. a lost decade for stock investors. Bonds performed even worse as interest rates soared and bond prices collapsed. The traditional 60-40 portfolio was a disaster. But certain assets exploded higher. Oil prices spiked over 1,000% from $3 per barrel to $40. Energy companies saw massive profit growth. Exxon grew earnings at 17% annually while most companies struggled. Commodity-focused portfolios generated returns that traditional investors couldn't imagine. Gold was the star performer of the decade, rising from $35 per ounce to over $800, a 2,200% gain while stocks lost half their value. Silver and other precious metals posted similar returns. Farmland averaged 14% annual returns as food prices soared. Real assets protected against currency debasement while paper assets got destroyed. The pattern was clear. When governments print money to solve economic problems, that money has to go somewhere. It flows into real assets, commodities, precious metals, energy, farmland, things with intrinsic value that can't be printed or manipulated. The investors who understood this rotation preserved and grew wealth, while everyone else got poorer. The stagflation period proved that diversification means more than just owning different stocks. It means owning different types of assets that respond to different economic conditions. Stocks for growth periods, bonds for deflationary periods, commodities for inflationary periods, and precious metals for currency crisis periods. The four-asset shield was born from these lessons. March 2008, Bear Stearns collapses. Lehman Brothers files for bankruptcy. AIG needs a government bailout. The global financial system teeters on the edge of complete collapse. Credit markets freeze. Housing prices crater. Unemployment soars. The worst financial crisis since the Great Depression unfolds in real time. Most diversified portfolios failed spectacularly. Correlations that had held for decades broke down as panic selling hit everything simultaneously. International stocks fell with domestic stocks. Corporate bonds fell with equity markets. Real estate investment trusts collapsed alongside the housing market. Traditional diversification offered no protection, but institutions with truly diversified portfolios survived. The Yale University Endowment weathered the crisis relatively well because of its allocation to alternative investments: real estate, private equity, natural resources, international assets. When traditional correlations broke down, these alternatives provided the stability that stocks and bonds couldn't deliver. The crisis revealed the importance of simplicity in investment products. Complex financial instruments became impossible to value or sell during the panic. Credit default swaps, collateralized debt obligations, structured investment vehicles. The more complex the product, the more it lost value when liquidity disappeared. Simple liquid investments became precious during the crisis. Gold emerged as both a hedge and a safe haven during the meltdown. While most assets were falling, gold maintained its value and provided portfolio protection. Treasury bonds also rallied as investors fled to safety. The flight to quality created massive opportunities for those positioned correctly. The 2008 crisis taught investors that correlations are not constant. The assets that seem uncorrelated during normal times can become highly correlated during crises. That true diversification requires assets that respond to different fundamental drivers, and that liquidity becomes critically important when markets seize up. These lessons would be tested again just over a decade later when a global pandemic shut down the world economy and sent markets into panic mode once again. March 2020. A virus most people had never heard of shut down the global economy in a matter of weeks. Entire industries ground to a halt overnight. Airlines cancelled flights. Restaurants closed their doors. Manufacturing plants went dark. The fastest economic collapse in modern history triggered the fastest bear market in stock market history. The S&P 500 fell 34% in just over a month. Volatility spiked to levels not seen since 2008. Oil prices went negative for the first time in history as storage facilities overflowed and demand evaporated. Corporate bonds cratered as investors feared mass bankruptcies. Even Treasury bonds, the ultimate safe haven, experienced unusual volatility as forced selling hit every market. But the four-asset shield portfolio held firm. While traditional 60-40 portfolios struggled with both stocks and bonds falling simultaneously, the commodity allocation provided crucial protection. Gold rallied as central banks around the world unleashed unprecedented monetary stimulus. Agricultural commodities remained stable as food demand proved resilient. Energy positions, while volatile, recovered quickly as supply cuts balanced the market. The pandemic revealed something critical about modern portfolio construction. Geographic diversification mattered more than ever, as the crisis hit different regions at different times and with varying intensity. Asian markets recovered first, European markets struggled longer, American markets experienced extreme volatility but massive policy support. Global portfolios were less exposed to regional performance gaps than domestic-only strategies. Companies with strong environmental, social, and governance characteristics suffered smaller declines during the crisis. Quality mattered more than growth potential when survival became uncertain. Dividend-paying stocks with proven business models outperformed speculative growth names. The flight to quality created massive divergence between strong and weak companies. Cryptocurrency emerged as an unexpected portfolio diversifier during the pandemic. Bitcoin and Ethereum, initially falling with risk assets, quickly recovered and posted massive gains as institutional investors began treating digital assets as portfolio hedges. Gold-backed tokens provided exposure to precious metals without storage concerns. The digital asset revolution accelerated during lockdowns. The speed of the COVID recovery taught investors that bear markets create opportunities for those with dry powder. Portfolios with cash reserves could buy depreciated assets during fire sales. Those fully invested at the market peak missed the buying opportunities that created generational wealth. Liquidity maintenance proved as important as asset allocation. Central bank intervention reached unprecedented levels during the pandemic. The Federal Reserve cut rates to zero and launched quantitative easing programs that dwarfed previous efforts. The European Central Bank expanded asset purchases. The Bank of Japan increased bond buying. Currency debasement accelerated globally as governments chose inflation over deflation. This monetary response validated the commodity allocation of the four-asset shield. Real assets benefited from currency debasement, while financial assets faced valuation concerns. Agricultural commodities rallied on supply disruptions and demand shifts. Industrial metals surged on infrastructure spending. Energy recovered on production cuts and economic reopening. The rotation from financial assets to real assets played out exactly as the historical pattern predicted, but the pandemic was just a warm-up for what came next. By late 2021, inflation began rising faster than central banks expected. Supply chain disruptions persisted longer than anticipated. Labour shortages drove wage growth higher. Commodity prices continued climbing. The easy money policies that rescued markets from the pandemic were creating the next crisis. 2022 brought the return of inflation and the collapse of everything that worked during the previous decade. The Federal Reserve pivoted from emergency accommodation to aggressive tightening. Interest rates rose from 0 to over 5% in 18 months. The fastest monetary policy shift in modern history triggered the worst performance for traditional portfolios since the 1970s. The classic 60-40 portfolio suffered devastating losses as both stocks and bonds fell simultaneously. For the first time in decades, diversification between equities and fixed income offered no refuge. Stock market volatility returned with a vengeance. Bond prices collapsed as yields soared. Real estate investment trusts cratered on rising rates. Traditional portfolio construction failed completely. But the four-asset shield weathered the storm. Commodity positions exploded higher as inflation expectations soared. Energy stocks became the best-performing sector as oil and gas prices spiked. Agricultural futures rallied on supply disruptions and strong demand. Industrial metals benefited from infrastructure spending and supply constraints. The 20% commodity allocation that seemed modest during bull markets became the portfolio's salvation during the crisis. Quality became critical as market conditions deteriorated. Companies with strong balance sheets, steady profits, and dividend payments outperformed speculative growth stocks. Proven business models with pricing power provided protection in an inflationary environment. The flight to quality that characterized previous crises repeated once again as investors abandoned hope for high returns and focused on capital preservation. Currency strategies provided additional protection during 2022. Call options on the US dollar paid off as the greenback rallied against global currencies. Put options on bonds generated profits as fixed income prices declined. Volatility strategies captured the extreme price swings that characterized the bear market. Options became valuable portfolio insurance during the turbulence. The international dimension mattered more than ever as different regions experienced varying degrees of inflation and monetary policy response. European markets struggled with energy crisis and war. Emerging markets faced dollar strength and capital flight. Japanese markets benefited from yield curve control and currency weakness. Geographic diversification provided protection against regional policy mistakes. The 2022 bear market proved that correlations between traditional asset classes could remain elevated for extended periods, that bonds could not be counted on to rally during stock market declines. That diversification required more than just mixing stocks and bonds from different countries. The lesson was clear. Real diversification meant owning assets that responded to fundamentally different economic drivers. The pattern across all 5 crises revealed the same mathematical truth. Portfolios with exposure to stocks, bonds, and commodities experienced lower volatility and better risk-adjusted returns than traditional approaches. The rotation between asset classes provided natural rebalancing opportunities. The protection during crisis periods enabled compound growth over decades. The 4-asset shield wasn't just about surviving individual crises, it was about thriving across entire investment cycles. Cycles. The mathematics behind these 5 crises reveal something that most investors never grasp. Each crisis wasn't random. Each crash followed predictable patterns. Each recovery created massive wealth for those positioned correctly. And the 4-asset shield captured every single rotation. Look at the actual numbers across these disasters. During the 1929 crash, while stocks lost 74%, the balanced approach lost only 50%. That 24% difference meant keeping $40,000 instead of $26,000 on every $100,000 invested. The difference between rebuilding wealth and starting over completely, the 1970s stagflation period showed even more dramatic divergence. Traditional stock investors lost half their purchasing power over the decade, but commodity-focused positions gained over 1,000% in oil, 2,200% in gold, and 14% annually in farmland. The gap between paper assets and real assets became a chasm that separated winners from losers permanently. During 2008, diversified endowments like Yale survived while concentrated portfolios imploded. The difference wasn't luck, it was mathematical. When correlations spike to dangerous levels, only truly independent assets provide protection. Stocks, bonds, real estate, and commodities each responded to different fundamental drivers even when panic selling hit everything simultaneously. COVID proved that speed matters as much as direction. The 4-asset shield recovered faster than traditional approaches because commodity positions rallied while financial assets struggled. Energy rebounded on supply cuts. Agricultural products remained stable on persistent demand. Precious metals surged on monetary stimulus. The recovery happened in months, not years. The 2022 bear market delivered the final proof. When 60-40 portfolios suffered their worst performance in decades, the commodity allocation generated double-digit returns. Energy stocks became the only profitable sector. Agricultural futures rallied on supply disruptions. Industrial metals benefited from infrastructure spending. The 20% that seemed insignificant during bull markets became the difference between survival and destruction. But here's what separates sophisticated investors from the masses. They understand that portfolio construction isn't about predicting the future. It's about preparing for multiple futures simultaneously. The 4-asset shield works because it covers every possible economic scenario. Deflationary collapse favors bonds as interest rates fall, and credit quality matters. Inflationary spiral benefits commodities as real assets outpace currency debasement. Economic growth drives stock performance as corporate earnings expand. Currency crisis rewards precious metals as store of value becomes paramount. No single scenario dominates indefinitely, the rotation never stops. Rotation. The allocation percentages matter more than most people realize. 42% in stocks provides growth during expansion periods, while limiting downside during contractions. 38% in bonds offers stability and deflation protection without excessive interest rate risk. 20% in commodities seems small, but generates outsized impact during crisis periods when correlation protection becomes critical. This isn't equal weighting. This isn't random diversification. These percentages emerge from decades of crisis performance data. They represent the mathematical optimization between growth and protection, between offense and defense, between surviving individual crashes and compounding wealth across multiple cycles. The rebalancing discipline transforms the four-asset shield from static allocation to dynamic wealth machine. When stocks crash and commodities rally, you sell commodities and buy stocks. When bonds surge and stocks decline, you sell bonds and buy stocks. When inflation drives commodity prices higher, you take profits and rotate into bonds. The mechanical approach removes emotion and captures mathematical advantage. Most investors do the opposite. They buy what's going up and sell what's going down. They chase performance and flee volatility. They panic during crashes and celebrate during bubbles. This behavioral pattern guarantees wealth destruction over time. The four-asset shield forces the opposite behavior through systematic rebalancing. Consider what happens during a typical crisis cycle. Initial shock hits stocks first as fear spreads and liquidity disappears. Bonds rally as investors flee to safety and central banks cut rates. Commodities initially fall with deflationary concerns but recover as monetary stimulus begins. The rotation plays out over months, creating multiple rebalancing opportunities for disciplined investors. The recovery phase reverses these flows. Stocks rebound as economic data improves and earnings recover. Bonds decline as inflation concerns mount and monetary policy tightens. Commodities surge on supply constraints and stimulus spending. Each phase creates profit-taking opportunities that fund the next rotation. The compound effect over decades becomes extraordinary, not from hitting home runs during individual periods, from consistently hitting singles and doubles while avoiding strikeouts, from participating in every rally while surviving every crash, from mathematical advantage that most investors never recognize. The institutional money understands this framework completely. Sovereign wealth funds allocate across all four asset classes. University endowments maintain exposure to stocks, bonds, and alternatives. Central banks hold foreign currencies, government securities, and gold reserves. Pension funds diversify across equities, fixed income, and real assets. They learned these lessons from previous crises. But individual investors typically ignore these patterns. They chase last year's winners. They concentrate in familiar assets. They panic during volatility and celebrate during bubbles. They follow financial media recommendations that change with market sentiment. They repeat the same mistakes that destroyed previous generations. The next crisis will follow the same mathematical principles that governed the previous 5. Asset correlations will spike during the initial panic. Central banks will intervene with monetary stimulus. Governments will increase fiscal spending. Currency debasement will accelerate globally. Real assets will outperform financial assets. Quality will matter more than growth potential. The specific trigger remains unknown. Geopolitical conflict, debt crisis, technology disruption, climate disaster, financial system failure, currency collapse. The cause matters less than the response. Markets will panic first and think later. Correlations will break down. Diversification will fail for most investors. But the four-asset shield will rotate into protective positions automatically. The timing remains unpredictable. Crisis could emerge next month or next decade. But the mathematical certainty continues. Excessive leverage creates instability. Asset bubbles eventually burst. Central bank intervention creates distortions. Government spending drives inflation higher. Currency debasement benefits real assets. The cycle repeats with mathematical precision. Understanding this pattern provides enormous advantage for patient investors, not from timing markets perfectly, from positioning portfolios correctly, from owning assets that profit from chaos while others lose everything, from compound growth that accelerates during crisis periods when opportunity cost disappears. The four-asset shield isn't about avoiding all losses, it's about controlling losses while capturing gains, about surviving crashes while participating in recoveries, about mathematical advantage that compounds over decades, about turning market volatility from enemy into ally. Ally. The wealth management industry spends billions convincing you that complex strategies and exotic investments will protect your portfolio. They're wrong. The most sophisticated hedge funds with armies of PhD mathematicians get destroyed during every major crisis. The most complex structured products become worthless when liquidity disappears. The most celebrated fund managers who dominated bull markets vanish during bear markets. Complexity is the enemy of crisis performance. When markets panic and correlations spike to dangerous levels, simple beats sophisticated every single time. The four-asset shield succeeds precisely because it's mathematically elegant rather than operationally complex. 4 asset classes, 3 allocation percentages, 1 rebalancing discipline, nothing more. But simplicity requires understanding the deeper mechanics that most investors completely miss. Each asset class within the shield responds to different fundamental economic drivers. Stocks react to earnings growth and economic expansion. Bonds respond to interest rate changes and credit conditions. Commodities move with supply constraints and currency debasement. The mathematical independence creates natural hedging without complicated derivatives or structured products. This independence breaks down temporarily during crisis periods when panic selling hits everything simultaneously. But the breakdown creates opportunity rather than permanent destruction. When forced selling drives commodity prices below fundamental value, while monetary stimulus drives bond prices above reasonable levels, the rebalancing mechanism captures this mathematical distortion automatically. The behavioral psychology behind crisis performance reveals why most investors fail repeatedly. During bull markets, they become overconfident and abandon diversification for concentration. During bear markets, they become fearful and abandon systematic approaches for emotional reactions. The 4-asset shield removes both behavioral extremes through mechanical discipline. Consider the emotional cycle that destroys individual investors during every crisis. Initial denial that anything serious is happening, growing concern as losses mount beyond comfort levels, panic selling near market bottoms when pain becomes unbearable, gradual optimism as recovery begins but prices remain depressed, full participation only after significant gains have already occurred. The evidence across nearly a century of market catastrophes proves that mathematical principles matter more than market predictions. The 4-asset shield survived every crisis because it embraces the fundamental truth that sophisticated investors understand. Wealth isn't built by avoiding volatility, it's built by positioning correctly before chaos arrives. The next crisis is coming whether you're prepared or not. The only question is whether you'll be holding the assets that profit from panic or the ones that get destroyed by it.